The Chinese economy accelerates faster than expected in March, even as inflation hits a 32-month high. Singapore's DBS Bank to double its workforce in China. And India's Infosys rings in lower than expected results. Good evening, this is Asia Business Tonight. I'm Timothy Ouyang. Our top story this Friday, the Chinese economy grew by a faster than expected 9.7% in the first quarter, and inflation jumped to a 32-month high, raising expectations of more tightening measures. Some analysts say they expect China's growth to moderate for the rest of the year, which could affect other countries along the value chain and also dampen its demand for imports.
Grocery shopping has become more expensive in China as the cost of living went up in the first quarter. Consumer prices rose 5.4% from a year ago, mainly because of a surge in food costs. That has heightened concerns about inflation. It has also raised expectations of more interest rate hikes.
For the rest of the year, they will probably have to do at least another 100 basis points of interest rate hikes. And because of how strong the GDP figures were, they probably have to front load these interest rates. For neighboring economies, if China's economy is going strong, this kind of puts an implication on inflation risks for the rest of Asia. And the rest of Asia would have to also stick to their tightening stance.
China has taken several tightening measures over the past year, including a rate hike last week, which was the fourth in 6 months. These were just some of the policies it took to cool growth. Observers believe that these could have a lag effect and start to be more prominent in the second half of the year. This could eventually affect regional economies feeding into its supply chain, such as the electronics industry. Some experts warn that there could also be further downside from the aftermath of the Japanese earthquake.
The big question is still what's the impact on China's value chain. Especially we know in China actually half of Chinese trades is from so-called processing trades. So which means if there's the breakdown in the value chain, we might see some big impact on Chinese growth going forwards.
China's economy expanded 9.7% in the first quarter from the same period a year ago. That's slightly lower than the last quarter's growth of 9.8%.
And for more analysis, I spoke with Dan Martin, global economist at the Economist Intelligence Unit, and I started by asking if we are seeing signs of overheating in the Chinese economy.
I think it's important here not to overreact. GDP didn't really slow in the first quarter. Inflation has jumped by 50 basis points to almost 5.5%. These are higher than comfortable, but they're not a massive shock. They're sort of at the upper end of expectations. Most analysts are expecting inflation to rise up towards maybe 6% over the next few months. So yeah, what we're seeing here hasn't really changed our view on what's happening in China. The economy is in danger of overheating, but this is something that's still manageable, I think.
Now, the government has already been taking measures to curb inflation, but the numbers today suggest that the efforts have not having so much of an effect so far. And the data today shows that inflationary pressures are broadening to non-food areas. Why do you think that's the case?
Yeah, well, food is the main culprit. Without food price inflation, we'd be running around 2.7%, which is higher than China's used to, but it's not a disaster. So we expect food prices to start coming down in the second half of the year, so then overall headline inflation will start to come down as well. But you're right, it has broadened out. Clothing prices are increasing for the first time in pretty much almost a decade. We're seeing housing prices rise very quickly. So there has been a broadening. The trouble is that monetary policy takes around 6 months, sometimes longer, to feed through into the economy. So we should start to see this have an effect as we later on in the year.
Now let's talk more about monetary policy tightening. How helpful do you think such measures are? And do you see policymakers being forced to allow the yuan to appreciate more at a faster pace than initially planned?
I think what we're going to see is interest rates going up again over the next few months. Look for one in May, around May Day. They like to sneak their interest rate increases in around public holidays. So they'll mainly try to do it through that and raise in reserve requirements. It would be nice if the renminbi appreciated a bit more. That would help this situation. It would also help to resolve some of the imbalances in the economy and shrink that big current account surplus that is causing problems with global imbalances. So it would be nice. And when Jabal has mentioned faster yuan appreciation, the trouble is the government's still so worried about hurting exporters, which would have quite a big effect on the economy. So I don't think you're going to see the pace of appreciation rise too quickly, especially because they can manage this through their domestic monetary policy.
Dan Martin from the Economist Intelligence Unit. Well, let's check in to see how Wall Street is doing this Friday, and markets there are trading mixed right